Good morning, everyone, and thank you all for participating in this special JAXUSA webinar sponsored by Blue Cross Blue Shield of Florida and ViStar Credit Union. While we're sad to be separated physically today for what would have been our second quarter JAXUSA luncheon, we are grateful to have our luncheon speaker, Dr. Raphael Bostic, President and Chief Executive Officer of the Federal Reserve Bank of Atlanta, to participate in our webinar with us this morning. Before I introduce Dr. Bostic properly, a few housekeeping notes. All participants are on mute to ensure there aren't any disruptions during the program. We are recording this program and it will be posted to jaxusa.org after the webinar has ended. Following the keynote address and fireside chat, we will be taking questions from the audience. Please submit your questions for Dr. Bostic at any time throughout this program in the Q&A function on the right side of your screen. We will ask as many questions as we possibly can with time permitting. Our program today is timely as our economy is in an uncertain place given the effects of the COVID-19 pandemic. The most recent U.S. unemployment figure states that 36 million Americans have filed initial unemployment claims, accounting for 1 in 5 people in the workforce. According to the Federal Reserve Chair, Jerome Powell, U.S. unemployment could peak at 25% as a result of this pandemic. On the state level, from March 21st through the last week of April, Florida's initial unemployment claims reached nearly 1.7 million. This figure is up nearly 4,600% over the same 6 weeks of last year. In March, Florida's unemployment rose to 4.3%, up from 2.8% in February. The Jacksonville region MSA saw a similar increase in its unemployment, increasing to 4.3% in March, up from 3% in February. So year over year, the Jacksonville region MSA increased its unemployment rate by nearly 1% compared to March of 2019. While the month of April's state and regional unemployment numbers won't be released until later this week, it is expected to climb as the true effects of the pandemic were felt last month. To give a broader view of the country's economic footing and how it will impact Northeast Florida, I am pleased to introduce Dr. Raphael Bostic. Dr. Bostic became the Federal Reserve's Bank of Atlanta's 15th president and CEO in June of 2017, where he oversees the bank's activities, including monetary policy, bank supervision and regulation, and payment services. He had previously worked at the Federal Reserve Board of Governors from 1995 to 2001, first as an economist and then as a senior economist in the Monetary and Financial Studies section, where his work on the Community Reinvestment Act earned him a Special Achievement Award. Prior to this time, he served in several academic and leadership roles at the University of Southern California, where he most recently served as the Judith and John Badesrian Chair in Governance and Public Enterprise at the Sol Price School of Public Policy. Dr. Bostic was also the Assistant Secretary for Policy and Development and Research at the U.S. Department of Housing and Urban Development, where he was principal advisor to the Secretary on Policy and Research. As a current member of the Federal Reserve's Federal Open Market Committee, he has helped shape the Fed's aggressive response during this pandemic crisis. Dr. Bostic has been accessible, authoritative voice in this uncertain time. He's been a frequent presence on webcasts and television before the general public, business people, civic and community leaders, public officials, journalists, students, and academics. Along with his Atlanta Fed colleagues, Dr. Bostic is closely monitoring conditions on the ground in the Southeast through a stepped-up program of personal conversations and surveys. And he is tracking broad economic and financial conditions through the bank's team of research economists. Through surveys and ongoing contact with nonprofits and other agencies, he and the Atlanta Fed are paying special attention to the effects of this crisis on our most vulnerable populations and communities. This work is part of the Reserve Bank's focus on economic mobility and resilience, of which we will hear more shortly. It is my honor to introduce President and CEO of the Atlanta Federal Reserve, Dr. Raphael Bostic. Good morning, sir.
Good morning, Andre, and good morning to everyone. Thank you so much for that great introduction. And I want to thank you, Andre, the JAXUSA Partnership, and the JAXUSA team for inviting me to speak this morning. This was supposed to be my week in Jacksonville. Sunday was supposed to be the beginning of the Financial Markets Conference that we have annually at Amelia Island. And we had scheduled a whole set of meetings around that visit, and I was going to basically stay for the rest of the week. So I was really disappointed that that conference didn't happen and that my trip to Jacksonville was put on the rocks. But I'm really glad that we're able to do this because I do think this is an important time to talk about the economy and to try to give you some perspectives on how I see the economy working, the sorts of things that I think we need to be thinking about, and to really get a better sense of the things that you're worrying about. Now, before I get too far into my remarks, I did want to just note that there are so many people in Jacksonville who have been helpful to the Federal Reserve Bank of Atlanta, and I just wanted to thank you for being great supporters of us. This meeting alone, I know we have the virtual presence of 6 current directors, 4 of whom are actually here. I just want to call out Paul Boynton, Tim Cost, Dawn Lockhart, and Bill West. And I want to thank them publicly for their participation in providing their insights to us about what we're doing. And I also wanted to just call out Nicole Thomas at Baptist Hospital and John Hirabayashi at Community First Credit Union. They're also directors of ours. I don't think they're on this call, but I know that representatives from their organizations are on. And so I would just please ask that you let them know that we've spotlighted you, let them know that we spotlighted them for their thank you. And I really want to just express my appreciation for the service for all of you. We also actually have a previous director, Linda Scherer, who's on, and a member of our Trade and Transportation Advisory Council, Rob Hooper. And we really rely so much on the expertise of people locally and to give us their insights, and I'm really grateful for that. Now, Andre mentioned our outreach. And so Chris Oakley, who is our regional executive in charge down in Jacksonville, did a quick review of the folks who have signed up for this meeting. And we've tallied 42 organizations that are represented here that have provided support for us through either our Regional Executive Information Network, Regional Economic Information Network, or one of our advisory councils. And I just want to thank you for that. That stuff is super important. We've actually ramped that up in recent weeks, and your input is really helpful. And for those of you who are on this call who have not yet contributed to us, if we call, I'm going to ask that you please make a point to take that call and to talk to us and tell you exactly what you want. I mentioned Chris Oakley. He's a great partner for me in giving me information, and the stuff that he collects and the insights that he gets do contribute directly to how we think about policy and how we understand how the economy is working. So this is a really vital time for us, and I'll say a little bit more about this later, I'm expecting, but this real-time information we're getting is absolutely critical. Now, I should say right now, just to be fully clear, that everything I'm going to say from here on out is really just a reflection of my views and opinions. They don't reflect the views necessarily of the Federal Open Market Committee or anyone at the Federal Reserve Bank of Atlanta, or basically anywhere else. They're just my views. All right, so what I want to do very quickly is talk a bit about my perspective on what we're experiencing right now, talk a little bit about the response, and then pivot to what we're doing now to see sort of what next steps might look like. Now, in terms of this crisis, this is a really unique experience that we're going through right now. Most economic slowdowns occur because there's been some buildup of risk that's gotten too excessive, or we've seen imbalances in labor markets or in other places that wind up not being sustainable, and they lead to contractions and retrenchment of economic activity. This situation has been quite different in the sense that we have a public health crisis. The introduction of the coronavirus into our communities represents an existential crisis for many individuals. And the public health response that's mandated from this, the social distancing, the keeping people away from each other, has spillover effects into economic activity. And it's those spillover effects that we are all experiencing right now, and that's what's made the Federal Reserve so integral in terms of its participation in a response. And so when you think about what this crisis has induced, one is it's really limited cash flows, either for households in terms of income, for businesses in terms of revenues, for governments in terms of tax revenues that then allow them to fund their activities, and for nonprofits who rely on sources of capital from a wide variety of places. And so that creates a lot of stress, and that stress is real. And then there's a potential spillover from this, in that if you don't have access to your usual cash flows, that might cause people to turn to credit markets. And so we could also see a stress on credit markets that could also lead to real pain and hardship. Now, what is true is that that's all played out, and we're seeing tremendous uncertainty. We're seeing tremendous pain. We're seeing people suffer and struggle in really significant ways. But what we've tried to do in terms of our response is really be mindful that before the virus arrived, the fundamentals of this economy were quite strong. We had almost 11 years of continuous growth. We were not seeing signs of robust or runaway inflation. And when we looked around to see if there were risks emerging that might suggest that economic growth might be at risk, we weren't seeing those, either on the sides of businesses in terms of the types of investments they were doing, or in terms of households and families and the things that they were doing in terms of investments and savings and all that. And so what we saw was an economy that had very good fundamentals. And so the strategy in terms of a response for relief has been to try to preserve as many of those fundamentals as possible, to make sure that when we get to the other side, we have those fundamentals in place so that we can rely on those to get the market and the economy growing again in a robust way. And so that's been our strategy, to really try to bridge the crisis, preserving as many fundamentals as possible. And if you look at the Federal Reserve response, there are a couple of things I would note. First, the Fed acted quick. It was bold, and it was decisive in terms of the measures that it took. We lowered our Fed funds rate to effectively zero, to make it clear that that the cost of capital will not be a burden for people today, or should not be a burden for people today, or in that recovery phase. We surveyed the marketplace and really committed to trying to make sure that parts of the market that we saw that were starting to break down because of the stresses that I mentioned before had an opportunity to stabilize themselves and continue to work. And so in very short order, we stood up or announced 9 facilities that were created over the last 6 or 7 weeks. Many of them are focused on financial markets. When the crisis and the virus hit, what we saw was a lot of stress and crisis strains in financial markets, to the point where there were real questions about whether those markets would be able to continue to function. So we issued facilities to really provide support for the Fed funds market, how we do our monetary policy, for federal government bond markets, for corporate bond markets, for money market mutual funds, for municipal bonds, and also for dollar swap markets. And in those financial markets, the sign of stress is really credit spreads, and the spreads had gotten quite large. What we saw after we deployed and announced those vehicles, is that those spreads started to come down, which really suggested to us that the facilities were doing their job in trying to help these markets continue to function, and so that the traditional ways that people got access to credit and to capital were still existing, so they weren't turning to the credit markets, and those could be preserved for other things. Now, there are other parts of the economy that also were showing signs of stress, so this just was not a financial market issue, and we totally recognize this. And so that we provided some backstop liquidity for the Paycheck Protection Program. And we also announced a Main Street lending facility, which we have been working on very hard, and I can talk a little more about that, but that's really designed to provide support for businesses in that mid-range, above the SBA limit of 500 employees or less, up to several $1 billion worth of revenue. So it's a thick middle that we're trying to provide support for. Now, there's one other thing I wanted to just say in terms of these facilities, and that is that many of the facilities are for things that the Fed has never done before. The Fed has never provided backstops for corporate bond markets in quite the way we're being asked to today or contemplating today. The federal government, the Federal Reserve has not provided backstops for municipal bond markets to provide support for state and local governments. So these are new things in the Main Street program as well. And so as we're going, we are learning. We're trying to stand things up, asking a lot of questions, and trying to make sure that we're designing these programs in ways that are maximally effective and that can touch as many parties as possible. So this is really important. And I would say I've been really impressed with the Federal Reserve team because we've stood up a lot of new things in a relatively short amount of time. And I think that's been quite remarkable. And I'm really proud of what our team has accomplished. Now, we do a couple of other things, and we've done a couple of other things in response. So I just wanted to quickly review. One is, the Fed is very present in the payment space. So we have been very active to ensure that the elevated demand for cash that has arisen because of the crisis has not overwhelmed the system. So I have people in my bank, and my colleagues around the Federal Reserve System have people who are making sure that demand for cash is being met, because all cash is in circulation starts in the Federal Reserve building, the facility. And then the CARES Act payments, those economic impact payments that have gone out, they've also gone through FedRail, so that whether it's been through a direct deposit or ACH type of lens, or through checks, we are playing an important role to make sure that relief gets to families in a timely way and without a lot of stress or disruption. Then the last thing I would just say in terms of a Fed response is that we've really been working a lot with our banking institutions to encourage them and make clear that we want them to deploy their capital as much as possible to provide relief for businesses and families. And we also want them to work with their customers to see if there are ways that they can modify some of their relationships and arrangements to make sure that that those arrangements are not extra burdens for businesses and people. And I would just tell you, I've been very gratified in talking to banking institutions. They are all doing this. They are all stepping up. And one piece of advice I give to folks when they ask me what things they should do is go talk to your bank institution and work with them and see if there are ways that you might get some relief. And I'm glad to say that has been progressing in a good way. Now, I do want to say that the Fed we have monetary policy, and we have some channels of relief that go through those banking and financial market challenges. But there are many other parts of the economy that need support where our type of support is not actually going to be the best suited for. And so the fiscal side of the house is an important piece to this. And I think what we've seen is a pretty dramatic response by fiscal agents to get a lot of relief out into the economy. So we've had 4 waves of legislation. The CARES Act is one that people have seen play out and touch a whole lot of different areas. We've seen relief in terms of forbearance and for homeowners. And then there's been direct support for specific sectors. The hospital sector has come under a lot of pressure because of this. Restaurants, airlines, and others that rely upon physical proximity of people to operate, they're under tremendous stress. And so we're seeing support to go to them as well. And so that's kind of where we are, and that's kind of what we've seen. And then the question is sort of what's coming next, and how should we think about things coming into the next period of time, next few months. And I would really focus on 3 things, 3 main questions. The first is really how do we deal with the public health crisis, right? As I said at the very beginning, this is a public health problem. And we've got to make sure that that part gets nailed down. So depending on how the virus progresses, that has real implications for what the shape of the recovery might be. The second is really what's going to happen with the reopening. So what we are seeing right now are states across this country really grappling with the idea about how to reopen responsibly and sort of re-engage and allow businesses and business activity and families to sort of re-enter the economic marketplace in a more robust way. How that plays out will also have significant implications for the type of recovery that we will see moving forward. And then the third question is really, to what extent is the relief working? And if it works, then we should see a lot of the job losses that have been reported in the data and that Andre talked about earlier in the introduction turn out to be temporary losses rather than permanent losses. And so, you know, for me, a big question is this relief getting to families and getting to businesses and nonprofits and governments in ways so they can sustain their workforce and their labor force? And so when we get to the other side, can pull them back very quickly and get them back into a productive stance. If we can do that, if we can make as many of those job losses temporary as possible, then there's a good chance that our recovery can happen in a more robust way. And so those are the really three questions that are coming on that I have and what we are looking at. Now, the one other thing I would say on this, actually there are probably a couple other things, but one thing that's top of mind is this is stuff that's happening in real time. Right? The relief is just getting to businesses, it's just getting to families, just getting to state and local governments. And so we are now in the business of monitoring and gathering information to see if the relief is helping businesses sustain themselves and make it more likely that they will be close to where they were before the virus, to understand, and also to understand where there are stresses, such that whether the amount of relief that has been received is adequate and sufficient and for how long that will allow businesses and families to hold out. And then also to identify places where that relief is not getting, because we have seen across the board, I talked to a lot of businesses and in a lot of different community contexts, and the penetration of some of these relief packages really does vary considerably. And so we want to understand those and see if there are ways where there might be opportunities to get relief more targeted to those who have not yet gotten it. And we're going to continue to gather that information. This is one of the reasons why I think it's really important that we are having, that you are aware about our outreach, so that as we go through the next couple of weeks, we may tap you to get your thoughts and views and perspectives on how you're doing and how your communities are doing in those three areas. So let me stop there as a particular quick sweep of how I think about things going. And I'll turn it back to you, Andre. I think we got a couple of questions that you and I are going to go through.
Sure, and thank you, Dr. Bostic, for those comments. One of the things I want to talk about is, you know, we had such a drastic decline, you know, once the pandemic was discussed and we went into stay at home. You know, talk to us about how you see the current state of the national economy versus the last time we had such a issue in terms of the economy from the Great Recession, the differences between the two. I think people really want to truly understand that.
So I think there are a couple of differences. You know, at first, the fundamentals at the Great Recession were problematic. There was a lot of risk in the system. People through their buying of homes at very high prices and very low money down were extremely highly leveraged. Many businesses were extremely highly leveraged. And so when the financial crisis hit, there wasn't any buffer. There were no safety nets. There was really no way for people to hold on. And so we saw dramatic and deep collapses, and in a way such that we didn't have solid fundamentals to rely upon. And a lot of the response was really about reestablishing the possibility of having solid fundamentals. Today it's quite different in the sense that a lot of those reforms, I think about banking reform as one example, uh, have really caused institutions that were pretty weak at those times to be much, much stronger. You haven't seen in the newspaper any issues about banking institutions requiring bailouts or anything like that. There's a lot of capital that they have, and my hope is that they'll use that capital in a useful way. And the second thing is that a lot of businesses were actually working, right? They were working leading up to the crisis, and their pain is not really driven by decisions that any business leaders or any families have made. And that I think is a qualitative difference, which I think has contributed to a change in what the response looks like. You know, these days I hear lots of people say that they don't think the Congress really can get anything done. Uh, but when we look at the response, it was bipartisan. I think there was a broad recognition that the pain and the disruption and the distress here isn't anybody's fault per se. And as a result, it's really allowed folks to come together and try to find out solutions. Now, the one similarity I would say is the challenge in trying to size what relief should look like. In the Great Recession, you'll recall when the TARP bill was first proposed, there was a lot of uproar about this not being enough, and others were saying this is way too much, and it led to a lot of wrestling. I think you're seeing the same sort of wrestling today in terms of, you know, is the 3 trillion or 6 trillion that has been infused into the system enough, and how do you know, or what signs should you look for to know when you don't need to do anymore? And we're starting to have those wrestling matches, and you know, it's not something that the Fed really weighs in on per se, but for me, I do think that it is important that that we try to find all the pockets of weakness that are out there and do what we can to relieve it, because if we don't provide that relief, then the probability that those losses and that distress becomes more permanent increases. And I think the goal at this point is to try to have that probability decrease.
Dr. Bostic, you talked about the great fundamentals and the sound principles that were in place just leading up into this pandemic crisis. Can we draw hope from that reality? You know, how might that affect the timing and strength of an economic recovery, because sound principles were in place before this pandemic hit? And as you indicated, it is a health crisis. Sorry for those of you that are on the line.
I totally think signs that my network connection is slow. So
okay.
Maybe we could try.
You want me to repeat the question, Dr. Bostic? Okay, great. Leading into this pandemic, all the fundamentals, as you indicated, were very sound. Can we draw hope from that? How might that affect the timing of this economic recovery?
So I actually do think that that is a source of hope, and I think that hope underlies the vigorous scale of the response. I think people do understand, and policymakers that I've talked to have clearly said this. They understand that, you know, if businesses were in solid shape, they were making revenues, they were hiring people, and if we can keep them that way, then we'll be fine, and the recovery should be robust. I think the real question that underlies this is to what extent does the public health response allow for that resilience to really play itself out? The longer that we have the uncertainty around people's ability to go out and engage in business without having a high fear or likelihood of catching the virus, the harder it's going to be for those businesses to stay resilient and for those fundamentals to stay solid. And so for me, if we want to avoid the amount of degradation of those fundamentals, we really have to get that public health issue in place. I was on a call earlier today, and we were talking about what is it going to take for people to be willing to get back on a plane, or go to a restaurant, or go to a show, or go to the mall, or go to a University of Florida football game? And all of those things, and that mental aspect of engagement in the economy, those are critical things that we have to really face. And so for me, I really think about, if we can restore the confidence that the average consumer has, and do that relatively quickly, then those fundamentals will be preserved, and the recovery coming out can be a bit more robust than it might otherwise.
Dr. Bostic, leading into this pandemic, we saw the Fed, as you indicated, act very aggressively. Can you kind of explain, some of the underlying objectives and thinking behind that particular response coming so quick? And I think for many of us, we were like, okay, what's really going on when the Fed came out so quickly? And talk to us about some of the historical lessons Fed officials are drawing on during this particular crisis.
Yeah, so I'm not an economic historian, but we have a bunch of folks on staff who are. And when they look back at previous economic slowdowns and crises, there's a common theme that emerges from all of that, which is that the Fed acted too slow, and the Fed didn't act big enough. They weren't bold enough. And those two realities really led to the prolonging of that economic slowdown and the deepening of it. So coming into this, I think the chair was he was pretty clear and pretty proactive in saying, look, if this gets to our shores, is going to be a lot of going on. So let's not be timid in this. Instead, let's be direct and be bold and get out there and try to get ahead of it, so that our maximum weight goes into the relief effort. Now, in terms of the scope, I also think that that we've been pretty remarkable. I mentioned in my remarks, the Main Street facility is something we've never done before. The municipal bond lending facility has been something we've never done before. Some of the corporate bond facilities are things we've never done before. These are all really creative things, and I think that we kind of committed, and it's been a philosophy of mine, that in this area, in this instance, we have to do what we can to preserve the fundamentals wherever they are, as long as we can do it legally. And so many of the programs that we have right now require backstop from the Treasury. And then the other part, so there's a lot of conversation we have back and forth with the Treasury about the use of their capital. And there was just a hearing on this yesterday. And then the other part is that we can only do lending, right? We can't do grants. And so that also puts constraints on the types of things and the types of relief we can offer. But within those constraints, we're going to do whatever we can. And I'm actually going to advocate for us to do whatever we can to provide that relief.
Dr. Bostic, are there any particular data points either on the health side or the economic side that we need to be paying close attention to in the next coming weeks to really give us some indication about how this recovery is going, so that on the local side, from an economic development standpoint, we can pivot to basically shore up things and try and make sure that we get people back into meaningful, gainful employment?
Yeah, so a couple of things I would point to. The first, at a very basic level, is just what's happening in terms of public health, right? And if we see viral infections that are trending up rather than trending down, that's a concern. If we see hotspots or spikes in areas where we're seeing lots of those sorts of infections happening, that's a concern. So we have to monitor that. We actually have to understand that. The second thing I'm really looking at is, what's happening in terms of, as we open up the economy, what's happening in terms of economic activity. Our businesses seeing that the levels of revenues are starting to approach more of what they were seeing before, but also just basic foot traffic and what's happening in terms of signs of individuals, the comfort of consumers to be out and about and engage. And then the third part I'm looking at, and I was just on a call yesterday, we did a survey of how many people are actually engaging in using actual precautions. right? So what share of folks are using masks and gloves when they go out? How many people are actually adhering to the social distancing? Because those are all factors from what public health leaders tell us that really contribute to that first part, that public health issue. And then there's another piece that I'm actually really curious about and really interested to know more about, which is how are businesses responding to the new norm, the new reality? Because if you're a restaurant and you've got a 6-foot distance requirement, you can't have as many tables in the store as you could before, right? And what does that mean for your business model? What does that mean for how you employ people? What does that mean for your willingness to entertain the notion of doing curbside delivery? I've been really impressed with how many businesses, how many restaurants in the Atlanta area that were full-on sit-down fine dining have become takeout places, and how they've figured out how to make that happen. That kind of adaptability is going to be an important additional factor that defines what our recovery is going to look like.
Let's stick with that point. You talked a little bit about, you just spoke about the consumer. Let's kind of talk about people. And since you've assumed the role at the Atlanta Fed, you've really made improving economic mobility and resilience a major priority. On February 11th of this year, I had the opportunity, along with some of my colleagues from the state of Florida, Georgia, Alabama, Louisiana, to be at the Fed and to discuss with your staff about opportunities to improve economic mobility and resilience across larger cities in the Southeast. Why is that important for you and your colleagues? And we've noticed this is definitely a different approach for the Atlanta Fed. A lot of my colleagues discussed this. Can recovery from this crisis happen in a way that is vastly different from that of the Great Recession in terms of lessening the wealth and income disparities?
Well, that's going to be tough. I mean, I hope so. And, a lot of this will depend on the resilience and our response in terms of relief. Let me step back and just talk about why I think economic mobility and resilience is so important. When I think about our mandates, we have two that are in the law. One is stable prices, and that's inflation. The second is maximum employment. And, if you ask people what is the measure of maximum employment, people give you all sorts of things, and there's not a hard number. The reality for me is that maximum employment depends on the state of our labor force. If you don't have a lot of people that have the skills so they're employable, then maximum employment may be 2 million people or 20 million people. If you have people who are employable and have those skills, it could be 100 million people or 10 million, right? And if you think about what economy you'd rather have, I think it's the one with 10 or 100 million rather than the one with a 20 or 2, right? So if we can get people to have the skills that allow them to be employable, they're going to be able to engage in the marketplace, and they will in turn be economically mobile. So by focusing on the barriers that prevent people from having that kind of economic mobility, I think we're focusing on the way to get us from a 2 million person, a 2 million job economy to a 10 million job economy, which will make us more resilient and more powerful and more innovative and really preserve our high quality of life here in the country. Now, in terms of the Great Recession, and in terms of all recessions in general, what we typically see is that recessions hit those that have the least the hardest. And so, if you put it in terms of economic mobility, those with the least mobility get set back the furthest, which makes it harder for them to then in turn get back to a place where they might have economic mobility at all. And so as I and my team are looking at what's happening with this pandemic, we're trying to ask the question, are we seeing differential impacts across communities based on their baseline levels of economic mobility and resilience? One example for this is we are partnered, we led a partnership with the St. Louis Fed to conduct a national survey that was supported by the whole system of low and moderate income communities. And we asked nonprofits and small businesses, how are they doing? What they told us was that, the demand for their services is actually going up because, the distress is great, but their ability to provide the services is going down. because their funding sources have reduced, and so they have fewer workers. So they are under like an extreme level of stress at precisely the wrong time. Then we also asked them how long do they think the recovery will take to reach their neighborhood to where they'll feel recovered, and a sizable proportion of them said 12 months at the earliest, and much further than that for many. Now, I know if you've looked at the papers, people have been talking about V-shaped recoveries, U-shaped recoveries, whatever. Many of them pointing to the third quarter as a turning point in terms of activity. If you're talking about a year out, that's 6 months beyond that. And so what that means is that we can't just declare victory when we get to a certain point. We need to remember that all the communities have been hit, and we need to make sure that we're doing all we can to get all those communities back. And if we keep that in our mind, I'm hopeful that this crisis will not exacerbate those differentials in income. Then there's one other thing I would just add to this, which is that the virus is having differential impacts within our communities, right? So African American communities are being hit much harder by this virus, and that puts them at risk. And they are collectively among some of the least economically mobile that we see in the United States. And so in this instance, it could be the health crisis exacerbates the economic crisis, which exacerbates all these disparities, which make it hard for people to live in a self-sustained way. So it's really a significant crisis, a significant challenge. And I'm really pleased. My team, we're thinking very hard about how we're going to newly engage and change our strategies to engage with communities across the spectrum to make sure that we're giving them the information and the support that they need to get ahead.
Great. Dr. Bostic, I've got a few questions from the audience here. How is the Southeast U.S. region projected to fare in the recovery compared to the rest of the country? What are our biggest strengths, and also what are our most glaring weaknesses?
So I have not done a formal analysis, region of the country by of strengths and weaknesses. For strengths, I think there's a lot of vibrant activity that's happening in markets across the Southeast. And I do a lot of traveling now, and I get to see a lot of the ideas, the innovation, the long traditions of hard work and productivity that happen through the Southeast. I think it's a real advantage that the Southeast more broadly is a fairly diversified economy. It's not like an energy-based economy or exclusively an entertainment-based economy. There's a lot of diversity that's around, and that's quite helpful. In terms of weaknesses, I do worry about the state of public health. Right. So if you look at just about any health metric, the Southeast fares a lot worse than that. Labor force participation in many southern states is lower than it might be otherwise. The percentage of families and people that have college degrees is lower in many markets, particularly in the large rural swath of the Southeast. And that's going to make it increasingly difficult for the people who live there to participate in the economy. And so those are some of the fundamental challenges that I think are pretty significant. I do think that this is going to be an interesting period as we are learning through things like this. That technology might mean that we're all actually a lot closer to each other than we think we might be in terms of where our homes and our communities are, and that might sort of give us an opportunity to strengthen our linkages. But we're going to actually have to do things to accomplish that. And I know in our institution, we're actually doing a lot of thought about how is this experiencing changing our thoughts about what's possible in terms of how you do work. I think that's going to happen across the board, and I'm hopeful that it will lead to new ways of doing work and getting together that exacerbates our regional strengths and kind of reduces the impact of our weaknesses.
Great. I have one more question from the audience here. So with the Fed essentially implementing modern monetary theory, what do you think will happen with its trillions of bond holdings when the COVID crisis is over? Explicit or effective cancellation of the Treasury holdings by write-off, or perpetual rollover?
So I have no commentary on what Treasury might do. I will say I don't think that that perpetual rollover is what we're going to see. Now let me say it like this. My view is that the goal of the relief that we're doing right now is to make sure that as many businesses and as many families get to the other side in as strong a stance as possible, and hopefully close to the stance they were at before. If that occurs, we will be positioned really to grow in a solid way. And the bonds that we're issuing, say if we do the municipal bonds, those have 3-year terms. They're going to roll off. I'm not anticipating that the things that we're doing in terms of the facilities are going to become long-standing liabilities of our balance sheet. And we will, over time, as recovery happens, return back to a stance that we were pre-crisis. The chair has said this, and I have said it as well. Emergency measures are for emergency times. And once those emergencies are over, those measures need to go away and be retired. I'm committed to making sure that happens, and with all the things that I can do. And many of the colleagues that I've spoken to are of the same mind. So I don't think that we should think about this as every dollar that we're spending today becomes a permanent reset of where we stand. And my hope is that if we do this well, we'll be extremely well positioned to pay down whatever debts remain on the backside.
Unemployment benefits be extended. Can you hear me? Can you hear me, Dr. Bostic?
I heard you're asking about unemployment benefits.
Yes, sir. Should programs like PPP, special unemployment benefits be extended beyond?
Well, I think that's the question that we're all facing right now. And my team is out asking questions about, if you got a PPP loan, how much longer do you think it'll allow you to operate? And if we're seeing signs that those timeframes are not going to be long enough based on what we expect recovery to look like, then it might make sense to contemplate those things. The same thing with unemployment insurance. If families don't have enough money to pay for their rent, that has downstream effects and implications for other parts of the economy that could lead to a cascading of effects. So we actually need to think about that. Now, I've seen a lot of discussions about unemployment insurance preventing people from wanting to go back to work. We can think about design of programs, and that's important. But at this point, I don't think it's in our interest to take any options off the table. I mentioned earlier that we're doing all this outreach. A lot of that is because the aggregate data that's coming in today doesn't give us a real-time picture of what's happening. It's just describing things 3 and 4 weeks ago, right? And so we need to be thinking about our policies in real time, collecting that information as we can. And if we see that more relief is needed because things are moving perhaps a little slower than we might otherwise, I think that we should seriously consider providing that relief.
Great. Well, Dr. Bostic, thank you for answering our questions on the economy today. Your insight has been very valuable during this uncertain time. To my audience, I know that there's a few other questions out there. Unfortunately, with time, we don't have an opportunity to get to them, but we'd like for you to stay up to date with the Federal Reserve Bank of Atlanta. Subscribe to their weekly newsletter by following the instructions that are up on the screen. You can also connect with them on their various social media platforms and their Economy Matters podcast. I also want to thank our sponsors again, Blue Cross Blue Shield of Florida and ViStar Credit Union for their support for today's program. And I want to thank the over 290 individuals that joined us on this particular webinar. Please join us for our third quarter luncheon scheduled for September 10th at the Hyatt Regency Jacksonville Riverfront. As the CEO for Blue Cross Blue Shield of Florida, Pat Garrity, will join us for a fireside chat and discussion about the state of healthcare. So thank you all stay safe and healthy during this time. Thank you, Dr. Bostic and everyone. Bye.
Thank you. It's good. Yeah. Thanks, Andre.
Appreciate it.